So today I wanted to talk about a company that I've never talked about before. I have started buying it recently because it has pulled back very significantly. This is Booz Allen Hamilton. BAH is the ticker symbol. First things first, if you get value out of the video, please like and subscribe. I really appreciate that. So getting right into it here, they are a consulting company for governments mainly. $16.5 billion market cap. So that's another thing that I really like, one of the many things. I'm looking at a lot of the mid-cap names, the smaller cap names, and even the smaller large cap names, because they are typically the companies that are not as overvalued, if not undervalued, like a company like this is, I think. They are very close to their 52-week low. They pulled back about 30% from their highs just back in like looks like October, November roughly. A free cash flow yield above 5% and earnings yield above 6%. I really like that. That means they're profitable. They're earning more than the 10 years, so that's another very good thing. Getting into their insights here, the profitability is okay. It's nothing amazing, but it is okay. Net margin 7%, operating margin 11%, free cash flow just under 6%. Return on invested capital 30%, return on equity 85%. Those are both very, very good numbers. They have underperformed the S&P a little bit over the last 5 years, but frankly, I'm not concerned because they're still projected to grow roughly in line with the S&P, and they're trading at about a 20% discount to the S&P currently. So I'm not overly concerned there. Growth is still good. They have a current ratio of about 1.5, which also is good. Analysts, their next year projected revenue and earnings is projected to go down, but the average analyst price target is still considerably above where it currently is. Like I mentioned earlier, the PE is currently at 16. The 5-year average is 29. The 10-year average is 23. I think probably around a 20 is probably about fair value where it's at right now. So I think it's trading at about a 20% discount, I think, to where it should be. If we look at its financials here, they've grown revenue. And again, one thing I'd point out about these financials is that they do have the fourth quarter of 2024 up to date. So these are very recently have been updated. The revenue all-time high, consistently growing every single quarter. If we look at its earnings per share, also all-time high, growing very nicely there. Shares outstanding, they're buying back basically every single quarter, going back about 7 or 8 years, which also is very good to see. So pretty much everything here, very good to see. If we look at their profitability numbers, operating margin is at an all-time high. Net margin is close to an all-time high. And then if we look at free cash flow margin is probably about average, but still solid. And that number is coming up recently. Return on invested capital, all-time high. If we look at return on equity, basically at like a decade high. And then if we look at free cash flow per share and revenue per share will be the last couple things here. Free cash flow per share basically at an all-time high. And then revenue per share is also at an all-time high. That number is literally going up every single quarter for the last decade, basically. So also very, very good to see. So if we look at the dividend, it'll be the last thing I'll get into here before we get into the valuation. The dividend, about 1.5%. The payout ratio is right around 25%. They're growing at around 11% per year. Those are numbers that I really like. A company that's growing about 11% per year, I really like that. I think it's almost perfect. It still gives them room to grow the business, still gives them room to buy back shares. So I very much like that. If we go back a decade, they've outperformed the S&P quite considerably, almost double. If we go back 5 years, let's see here. 5 years, they're actually ever so slightly below the S&P. So like I mentioned earlier, this is a company that consistently either keeps up with or outperforms the S&P. If we go back a decade, you would have about a 7% yield on cost. That is the power of a company that's growing their dividend, 11, 10, 15-ish% per year. That's exactly what you want to see. And then, so I think that it's fair to say this is a pretty solid company. So let's get into the valuation here, because that's what it comes down to. Just because it's a good company doesn't necessarily mean you should buy it. So if we go back 5 years, they've grown earnings about 20% per year, just under 20% per year. They've grown revenue 15% per year. The average PE is about 28. They're currently at about 16. So if we go back a decade, they've grown earnings at about 18.5% per year. They've grown revenue about 11% per year. Average PE is about 24. So they're considerably below their average PE. Even their average price to operating cash flow is 22. They're currently at 17.5 roughly. So they're considerably below that. They're still projected to grow about 12% per year. Now, again, that's less than what they've done historically. So I think it's fair to say that they shouldn't be trading at a 24 PE, but I think probably 18 to 20 is pretty reasonable. Like, I think there's no reason that isn't a reasonable PE for them to be trading at. So let's do a DCF on them. I've already actually done it. So I'm projecting them to grow net income or earnings 10% per year, which is a little bit less than the 12 or to 15 that they're projected. They're going to buy back 1% of shares, which also is less than what they've historically done. They're going to grow their dividend 10% per year, which is also less than they've historically done. And they're going to trade at a 17 PE, which is I think a little bit of a discount, if anything. That assumes that fair value is actually 27% above where they are right now. They're going to grow 12.5%. Even if we go down to a 15 PE, that still implies that they are 13% undervalued, and they're still going to grow 11% per year. So this is why I'm buying this company right now. I don't think that they're the greatest company in the world necessarily, but I just think that they're too cheap to ignore where they are at right now. I would be buying them. Again, people are looking for a price target. I would be buying them right now, and I would probably stop buying them around $150 a share roughly. They are currently around where they currently are around. They're currently around 130, give or take, high 120s, low 130s. So I think it's fair to say they definitely are undervalued, but they're not necessarily egregiously undervalued, just a little bit. In that 10 to 20% undervalued, I think it's fair to say. That's why I'm buying them. So anyway, like I mentioned at the start of the video, if you get value, please like, subscribe, comment, all that good stuff, and stay tuned for more.